Think about how the market evolves. Think about what gamma means. If I give you any price at any strike, think about what a market means, guys. If I give you a price that's got a gamma attached to it, it doesn't matter what this price is, it doesn't matter what market it is. If I tell you that gamma's positive here, if I tell you that gamma's negative here, then obviously what does that mean for the dealers? Remember, this is dealer gamma. This is dealer gamma, not the trader gamma, the dealers. So if the dealer's gamma is positive, as the price goes up, they don't really have any desire to do very much with this, do they? They don't have much desire to deal here, so they're going to be happy to let the price goes up as much as possible. And when it gets to a point, obviously, that they think there's a bit of weakness, they'll sell on an uptick. They'll sell on an uptick. They won't be selling on a downtick. And that'll cause the price just to stall a little bit. It'll come back up. There's no selling on a downtick. And if it comes back up, they'll maybe sell a little bit more. It's not a sell on a downtick. So when the gamma's positive, sell patiently on upticks. Okay? So that's what the dealer's going to do, sell patiently on upticks. Now what happens if the opposite happens? What happens if the market starts to come down? Nothing, 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 nothing. And when it hits negative gamma, what have they got to do? They're now going to be selling on downticks. So if they're going to sell downticks, can you see how that changes the volatility, the nature of the volatility? This is obviously becomes very, what's called very, very slippy. The market becomes very slippy because of the gamma structure below this price. They're not selling upticks passively. They're selling downticks aggressively because they need to. They need to get away. They need to do this bit of business. And that's the difference, guys. That's why it was vital for today's bulls to get the price above this area here. They failed, and because of that, you can see what's happened next. Because they failed to negotiate that price out of that area, look at the speed of the candles. So the sell acceleration in this area here, then the acceleration here, and then the acceleration through this phase here, the acceleration into the bottom edge. It's just all acceleration, isn't it? It's all fast money moves. It's all fast money moves, guys. And that's what we warned about before it even happened, and that's what gave you a great storyline. So who did get the short oil? I'm sure everybody got the short oil. Who got the short oil? Everybody got the short oil. What did I say about coming into that toxic level at 45s, 40s, 40s, 35s, 50s? I said, sell the thing, sell the thing, sell into that big toxic oil level at the top edge. It's going to spill out. That was a live trade call, wasn't it? You might say, it wasn't a live trade call. You never called that. I think you'll find we did, guys. I think you'll find we did. I even got 2 likes for it. 2 likes, Kim, for a $1,000 oil trade. You guys are hard, I'll tell you. You guys are a hard audience. This is the deal. You can see that short on offers, 323. So that was sent out at 322. 322 starts on the 321 candle, which is right there. Where is the finished auction? The finished auction is there. Correct? Is that the finished auction? Yes, it is. Where is the short trade? There is the short trade. 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 What's the outcome from that short trade? 65.30s to 64.10s. $1,200. We are killing the markets today, guys. Over $2,000 a contract on the NASDAQ. Live tweeted. Over $1,000 on the oil. Live tweeted. And a live classroom this morning on gold for over $1,600 per contract. Live classroom on the right-hand edge. Not a single bit of this is hindsight Charlie stuff. It's all right-hand edge, cutting edge stuff, and we are absolutely annihilating the markets today, guys.